Right now, the most dangerous thing the Nasdaq 100 is doing is, well, it's doing absolutely nothing.
Yeah, it's completely frozen.
Right, and it's this paradox that catches so many people off guard.
Yeah.
I mean, we're all conditioned to fear those violent market crashes or, the euphoric meltdown.
Oh, exactly. The big moves.
Yeah, but the real silent killer of capital is often a market that's just trapped in severe volatility compression. So, welcome to the deep dive.
Glad to be here.
Today, we have our sights set on a highly specific, high-resolution snapshot of the Nasdaq 100 index, the NDX.
Specifically, we're looking at that 1-hour chart.
Right, we're mapping out the 1-hour chart dynamics.
Yeah.
And this technical breakdown, it comes directly from an update by the Investor's Edge channel, which was published on July 3, 2026.
That's right.
So, okay, let's unpack this. Because our source data here, it paints a picture of a market that is fundamentally stuck inside a classic symmetrical wedge. And the pressure in the system is it's compounding by the hour.
What's fascinating here is that a symmetrical wedge on a 1-hour time frame isn't just, some geometric pattern for technicians to draw on a screen.
It's not just lines.
No, not at all. It's a literal map of liquidity drying up. When you look at that July 3rd snapshot, you are seeing a mathematical representation of a standoff.
A total standoff.
Exactly. Both the institutional buyers and the algorithmic sellers they're pulling their bids and asks closer and closer together. They are completely refusing to aggressively commit capital until the other side shows their hand.
So they're just staring at each other.
Pretty much. And it tells us exactly where the structural integrity of this market is failing and precisely where the trapdoors are located.
Right. And so to avoid stepping on those trapdoors, we really have to look at the immediate reality of where the NDX is positioned. According to the Investor's Edge data, the index is hovering right around 29,329.
Which is a very precarious spot.
It is. It's maintaining altitude above the lower boundary of that symmetrical wedge, but it is simultaneously creeping up on this massive overhead resistance area.
Yeah, the ceiling is right there.
Now, the analysis specifically labels this current state a consolidation phase. But given that you, our listener, already understand the basics of market structure, let's look at the actual mechanics of this specific consolidation.
Let's do it.
At 29,300, the market is pacing around in a shrinking room. I mean, the highs are getting lower and the lows are getting higher.
Which means the market is suffering from a complete lack of directional conviction. When you see a symmetrical wedge forming like this, you really have to understand it as a volatility sinkhole.
It's a sinkhole, yeah.
Yeah, because every time the price attempts to rally to the upper boundary, limit sell orders just suppress it. And every time it dips to the lower boundary,
the passive buyers jump in.
Exactly. Passive buyers absorb the selling pressure, so the swings become narrower and narrower, and more importantly, the volume usually drops off a cliff.
The big money is just gone.
Right. The major players are effectively stepping away from the keyboard. They are letting the retail traders and the high-frequency algorithms just chop each other up in the middle of this wedge while they wait for a definitive structural break.
And the analysis points to two incredibly specific indicators that confirm this mechanical standoff. The first is the 21 EMA.
Yes, the exponential moving average.
Right. The source highlights that the price is just endlessly fluctuating around this 21-period moving average. And we know the EMA is highly sensitive to recent price action, especially on a 1-hour chart.
It reacts very quickly.
It does. So what makes this flatlining behavior around the 21 EMA so treacherous for anyone trying to trade the trend right now?
Well, the danger really lies in how algorithmic trend-following systems operate. See, when a market is actually trending, a 21 EMA acts as dynamic support or resistance.
Like a trampoline.
Exactly, the algorithms use it as a launch pad. But when the price just weaves back and forth across a flattened EMA, like the Investor's Edge analysis points out, it generates continuous false signals.
So it's constantly faking people out.
Yes. A moving average crossover system might trigger a buy signal 1 hour, only for the price to fall back beneath the EMA the very next hour, triggering a sell.
Ouch.
Yeah, it whipsaws traders who are desperately trying to anticipate a trend that simply doesn't exist yet. The flat EMA is the market's way of explicitly confirming that momentum is completely dead.
Wow, okay. And that brings us perfectly to the second indicator the source relies on, which measures exactly that momentum.
Right, the RSI.
Yep, the analysis states the RSI is hovering right near the middle range. It's perfectly neutral. Now, seeing an RSI at 50 on a daily or weekly chart is one thing, but seeing it dead center on a 1-hour time frame right in the middle of a symmetrical wedge, I mean, that feels like a ticking time bomb.
It really is. It is the quantitative definition of absolute equilibrium. An RSI at 50 inside a tightening wedge means that the total magnitude of recent gains is exactly equal to the total magnitude of recent losses.
The tug of war is at a dead stop.
A complete dead stop. Neither the bulls nor the bears are willing to exhaust the capital required to actually skew the momentum. But the caveat there is that equilibrium in financial markets is inherently unstable.
It can't last forever.
It cannot last. The longer the RSI flatlines at 50 while the price action gets squeezed into the apex of that wedge, the more violent the eventual expansion of volatility will be.
Because someone has to give up.
Right. It's a mathematical certainty that someone is going to be forced to capitulate.
So let's talk about what happens when that capitulation finally hits. And let's start with the upside scenario. The ceiling holding this market down is formidable.
Very much so.
The investor's edge analysis maps out a critical supply zone, which is the primary resistance level, and it's stretching between 30,194 and 30,650.
That's a key area.
Yeah, and the source is adamant that this specific zone is the strongest resistance on the entire chart. They note it has rejected the price several times already.
Yeah, it's a brick wall right now.
Right. And they state that as long as the price trades below this zone, the sellers are in control. But I want to push back on that phrasing for just a moment.
Okay, sure.
If the momentum is completely neutral, right, and we are currently hovering at 29,329, how can we objectively say the sellers are in control? Aren't they just, I don't know, defending a perimeter?
Well, that is a crucial distinction to make. When the analysis states sellers are in control below that zone, they aren't implying that sellers are aggressively driving the price down right this second.
Because the RSI at 50 proves they aren't.
Exactly. The neutrality of the RSI proves they aren't attacking. What it means is that the sellers retain overarching structural authority.
Okay, how so?
Think of that 30,194 to 30,650 zone like a massive institutional sponge.
A sponge, yeah.
Every time buyers try to push the price into that territory, there's a dormant block of limit sell orders just waiting to soak up all that demand. The buyers have the burden of proof here.
Right, they had to prove they have the cash.
Exactly. Until they can demonstrate enough capital firepower to completely chew through all the supply sitting at 30,650, the sellers dictate the ultimate ceiling of the market. The structure is inherently capped.
So flipping the script requires a massive injection of liquidity. The source outlines the specific criteria needed for buyers to actually seize control.
And it's very specific.
It is. It's not just a matter of piercing the line. To confirm a bullish breakout, buyers must successfully break and close above both the upper boundary of the symmetrical wedge and that 30,650 ultimate resistance level.
That close is everything.
Right. The emphasis on the close of the 1-hour candle is something we really need to dissect. Why is the inter-hour price action irrelevant compared to the closing print?
Because the inter-hour price action is heavily manipulated by liquidity hunting.
Liquidity hunting.
Yes. On a 1-hour chart, it is incredibly common to see the price suddenly spike up to, say, 30,700. Retail traders see the breakout, they aggressively buy in, and short sellers panic and cover.
It looks like a real move.
It looks real, but it's a trap. Institutional algorithms are simply engineering that spike to trigger those orders so they have enough liquidity to offload their own massive sell positions.
Oh, wow.
Yeah. Once they dump their shares, the price just collapses back down before the 60 minutes are up.
Resulting in a massive rejection wick on the chart, leaving all those breakout traders totally stranded.
Precisely. That's why the analysis demands a confirmed close. A 1-hour close above 30,650 proves that the buyers didn't just, poke their heads above the parapet.
They actually held the ground.
Exactly. They held the high ground for the entire period. It proves they absorbed every single share the sellers threw at them and still maintained the elevated price.
That's a huge difference.
It is. That confirmed close is the trigger that forces systematic trend followers and quantitative funds to flip their biases from neutral to heavily long.
And when those systematic funds flip, the upside targets become highly compelling. According to the Investor's Edge analysis, a confirmed breakout past 30,650 triggers a fresh wave of buying momentum that pushes the immediate target to around 31,000.
That is a major psychological level.
It really is. And hitting 31,000 isn't just an arbitrary round number. The source notes it would actually challenge a new all-time high for the Nasdaq 100, which opens the door for even higher extensions. It basically clears the order books of historical overhead resistance.
Right, it creates a blue sky scenario.
A blue sky scenario.
Yeah, because once you break above a multi-rejected resistance like 30,650, you are stepping into a territory where there are no historical bag holders waiting to break even by selling their shares.
There's anyone waiting to dump on you.
Exactly. The supply side of the equation virtually evaporates, which is why momentum can carry the price upward with terrifying speed.
But the reality of a symmetrical wedge is that it has two boundaries.
Right, we can't ignore the bottom.
Exactly. We've looked at the ceiling. Now we have to pivot and examine the structural integrity of the floor. Because if that floor gives out under the weight of this consolidation, the downside is steep.
Very steep.
The source details the first major demand zone, the primary support, as being located between 28,200 and 28,850. But what makes this specific zone so pivotal is that it aligns perfectly with the lower boundary of our symmetrical wedge.
Right, and if we connect this to the bigger picture, you immediately realize why 28,850 is a structural nexus.
The nexus, okay.
Yeah, because it is not just a horizontal price floor where buyers previously stepped in, it is also the dynamic trend line that defines the entire consolidation phase.
So it's two lines crossing.
Exactly. When you have two major technical structures overlapping at the exact same price point, you get an incredibly dense cluster of liquidity. Every single trader who is long this market right now is looking at 28,850.
Everyone sees the same line.
Yes. They know that if that level fails, the whole thesis is dead.
And here's where it gets really interesting. The analysis is blunt. If sellers manage to break and close below that 28,850 line, the entire consolidation pattern fails. It's a complete structural breakdown.
It's game over for the bulls.
So what is the mechanical chain reaction that occurs in the order books when a nexus point like that snaps?
Well, it initiates a cascading liquidity vacuum. Think about all those buyers who have been patiently defending the lower boundary of the wedge. Where do you think they place their stop-loss orders?
Right below the line.
Exactly. They place them just below 28,850, and a stop-loss on a long position is, mechanically, a market sell order.
Right.
So the moment the price slips below 28,850, it trips a wire. Thousands of automated sell orders hit the market all at once.
Which instantly overwhelms whatever passive bids are left in the book.
Right. And because the breakdown confirms a failed wedge, the algorithms that trade momentum immediately open aggressive short positions.
So it just adds more fuel to the fire.
Yeah, exactly, adding even more sell pressure. The buyers pull their bids, stepping away to protect their capital, which just removes the floor entirely.
And the analysis maps out exactly how far that floor can drop. A confirmed breakdown below 28,850 opens the door for a rapid decline toward the bottom of that demand zone, targeting 28,200.
That is a fast drop.
Yeah, that's a roughly 600-point slide on the index. But the source issues a rather stark warning beyond that. They say if the 28,200 demand zone fails to hold, the Nasdaq 100 could extend its decline significantly over the coming sessions. The structural damage would just be immense.
Yeah, because a failure at 28,200 would signify that the long-term institutional buyers are refusing to defend the asset, even at a deep discount.
That's scary.
It is. It signals a macro shift in sentiment, transitioning the chart from a temporary consolidation into a confirmed multi-session downtrend. The selling would transition from being purely technical, driven by stop losses, to being fundamental as larger funds start to de-risk their portfolios entirely.
So what does this all mean for you, listening right now? When we synthesize this July 3rd technical snapshot from Investor's Edge, we are left with a profoundly asymmetric situation.
We really are.
The Nasdaq 100 is at a critical decision point. We have a symmetrical wedge compressing the price, a 21 EMA acting as a volatility trap, and an RSI practically bolted to the 50 line. The overarching advice the source provides for navigating this specific setup is uncompromising. Patience is mandatory.
It is the ultimate test of trader psychology. In a low volatility, range-bound environment governed by these clear supply and demand zones, the math simply does not support early entries.
You can't just guess.
No, anticipating the breakout before the 1-hour candle actually closes is just gambling on a coin flip inside a high-noise environment. The institutional algorithms are literally designed to penalize impatience.
Which is why the source emphasizes waiting for that definitive confirmation.
Yeah.
You either wait for the close above 30,650 to ride the momentum toward new all-time highs at 31,000.
Or you wait for the structural breakdown.
Exactly. You wait for the structural breakdown below 28,850 to capitalize on the drop toward 28,200. Anything in between is just noise. And proper risk management means ignoring the noise.
Very well said.
And if you found this breakdown of the current market structure valuable, the original source analysis strongly encourages you to hit subscribe and give the video a like over at the Investor's Edge YouTube channel.
They do great work.
They really do. They're providing the daily U.S. stock market news and the specific technical frameworks that make this level of analysis possible.
Which, it leaves us with a rather profound reality to consider. We spend so much time analyzing these precise metrics like the EMA flatlining, the RSI perfectly balanced, the rigid supply blocks at 30,650, and the demand pillars at 28,850.
Right, all these specific numbers.
Right. But we really have to ask ourselves, how do these entirely invisible lines on a screen act as such powerful, self-fulfilling prophecies?
That's a great question.
When millions of market participants, human and algorithmic alike, all recognize the exact same technical boundaries, the chart ceases to be a mere reflection of the market.
It becomes the market.
Exactly. The invisible lines dictate the sudden, violent movements of global capital, not because they are inherently real, but because our collective belief in them makes them real. It's the moment psychology and mathematics become entirely indistinguishable.